everyone. Hope everybody is doing well. I will go through questions at the end. So, overall, a few things. One, on the daily chart, I mentioned this on Friday, but we had a rally from October 2022 down here. Let me move this out of the way. Here was the October 2022 rally, and it lasted all the way until about July of this year. And we've sold off for a couple of legs down. And right now, the market's deciding, is the sell-off strong enough that we're going to get down to the October, that the open of the year, maybe this higher low right here, or maybe even this higher low right here. At the moment, the market's always in short, but it's always in short in a trading range. Targets for the bears. The first target is the midpoint of the year, which is this thick red line, and it's around 41.72. And I suspect we will probably find some support down there. With this many bars down, 3 consecutive decent bear bars closing on their lows with a little overlap here, but not much overlap right here. It's a strong enough breakout. We're probably going to go at least a little bit lower. However, as expected, bad follow through today. And the bad follow through is a warning that we're probably going to go sideways. Because the odds favor a second leg down, I think that will limit the amount of bulls buying right here. You had some bulls buying below October the 6th, scaling in lower for a scalp. But those bulls, those are limit order bulls. Stop order bulls, this is probably too early to buy. This sell-off is strong enough, I imagine we'll get a third leg down. It's a possible wedge, 1, 2, 3. But until there's more buying pressure, the odds favor sideways to down. If we do get buying pressure, I doubt we'll race up, but if we can start to get a trend line break, 2 or 3 strong bull bars, maybe a pullback and then a double bottom, that might be enough. But right now, we have trapped bulls, and those bulls, even if the market rallies all the way up here, what are those bulls going to do? You know those bulls are probably going to sell. How do you know that? Well, what would you do? If you bought here and you bought the close of this bar, and then that was your entry bar, and then you had another bar against you, you're sufficiently disappointed. And because the market's in a trading range, we could fall a long way. I think one thing traders have to realize is this, and maybe it's easier to see on a monthly chart. This is the cash index. Strong bull trend ever since the March of 2020, the COVID rally. We had a strong rally all the way up here. And if you look at this, anyways, we had a strong rally and a very deep trend line break. Obviously, this is a monthly chart, but if this was just a regular 5-minute chart, what would you be thinking about? Well, it's a possible lower high major trend reversal, but the channel up is tight, therefore probably sideways. But what if we break this trend line here, retest these highs here, start to go sideways, and then get a downside breakout? All in all, if you buy the point behind this, and Al's been saying the same thing, Al thinks we'll probably fall below the October 2022 low at some point. Now, that doesn't mean in the next couple of months. It could take a year to do that. But the point is, this rally is probably minor, and there's probably buyers below it. So for the bulls, if you're buying this close, stop down here, it's really a mistake. If anything, if you're buying here, what are you going to do if we fall here? You're going to buy more because the market's in a trading range. Ultimately, it's possible we get back down here at some point. So we think about measured move projections, sell off, rally. That would take you to a 30% pullback right there. What if this is a double top with here and this high, and we get a measured move down? Measured move from here to here takes you really close to the October 20 low. What if we get a measured move based on this entire flag? That would take you below the October 2020 low. This probably won't happen for a long time, but it certainly would not surprise me if it did. What would it take? At a minimum, we would need to see strong trend bars. And right now, there's no warning, or it's not clear that we're going down. It's 3 consecutive bear bars, and that will probably lead to sideways to down. But right now, this is not enough. So I suspect sideways. We're testing breakout points, and the reality is we're in a trading range. So if you sell the close of this bar, what's going to happen? Well, you're probably going to be disappointed. I think less likely we just plunge down. More likely this month, once October closes, November will probably be a bull bar and do something to disappoint traders. But what about buying above either the October high or the November high? Well, there's probably sellers not far one. It's a high one buy, but high one buys usually high in a trading range lead to reversals and deeper pullbacks. So if we go above this high, there's probably sellers above and we'll go sideways to down. And the weekly chart, we have a sell climax rally, sell climax rally, sell climax. Outside bars are typically trading range bars, and that will increase the probability that this week is a bull bar. But this week would need to be a very strong bull bar in order to undo the damage done by last week. And the other problem that this week would have, that really the sell off, the problem that the bulls have right here is this sell off is really tight. So if we go back to that monthly chart here, that's a lot of bear bars down. And if you just buy the close here, even if you bought a bull bar up here, you know it's probably going to lead to sideways trading. So what happened on the 5-minute chart today? Well, there's a couple of things. One, we had a pretty decent sell-off yesterday. We had a strong rally and then a sell-off down to here, and then continuation on Friday and a trading range, and then a brief sell-off today. So it's pretty much a bear break out of a channel. We've been channeling down for a lot of bars, and it doesn't really matter however we want to draw it. The point is several sell climaxes, and several sell climaxes on one time frame is a strong breakout on another. And that's obviously what we've had here. So the odds were, let's just put up let's do this. Let's put up maybe a 15-minute chart. And I'm going to change it to the ES.D since that's what we were talking about. Here's a 15-minute chart. We've been selling off for a lot of bars. If you go to a 30-minute chart, this shows how tight the channel is. We've been in a tight trading range here. We got a measured move down right here, went far below it. Let's see, do we reach here? No. Anyways, maybe a measured move from here. But anyways, tight bear channel. And we tried to form a trend line break here, but it led to a trading range and then a downside breakout. Strong sell off here, tight trading range. This led to a final flag, and we gapped down on the open, and we found buyers. How close did we get to? You can see we came really close to 4,200. We came within about 13 points. What are the chances that we get to 4,200? We will get to 4,200. This is kind of like yesterday. It's a larger version of yesterday. I say yesterday, I really mean Friday. Over here on Friday, if you're in the trading room, I mentioned that we came very close to, trying to remember what the magnet. Oh, it's kind of like it was the October 6th low. That's what it was. We came very close to it. It was at 4251.5. And you can see that is basically right here. So this was the October 6th low right here. And we tried to test it, and then we rallied pretty sharply. Typically, when you have a major support on higher time frames, you know it's going to get tested. So when you have a round number on right here, let's just use the daily chart because that's basically what we're showing. When you have a round number like 4,200, you know there's plenty of traders that are just institutional. You can call them swing traders, you can call them investors, whatever you want to call them. There's plenty of traders. They will buy in increments as the market sells off. One way to do that is round numbers. you buy at 4,400, you buy at 4,300, you buy at 4,200. And others, you can call that dollar cost averaging. But the point is, traders are buying at 4,200. And some traders, rather than buying at 4,200, what are they going to do? They're going to set a limit order above 4,200, maybe 20 points above it, betting on a bounce. And that happens pretty regularly. If we go to, this is the euro versus the dollar. And what I want to show is, I want to see really quick. I believe we reached this same thing happened, I believe, last year when we were around 1,000. So you can see, not a great example, but what I'm trying to show is here's 1.000. So obviously a very important price level. And you can see right here, the market sold off and bounced a little bit, even though we went below it. But the reason why traders buy round numbers is they know if they buy at this point 1.00 and then they buy, however many pips lower, maybe 200, 250 pips lower, and then another 250 pips lower, they're going to make money. And that's more just dollar cost averaging. Anyways, let's go to today. First thing I always draw is in this case, I'll often draw the open since it's the open of the week. But this here is the open of the week, open of the day. Probably will be important. And I'm going to go ahead and lock that. The next thing I often draw is the low of the day, or the low of yesterday. So here is Friday's low, which is the low of yesterday on this chart. And when I say low of yesterday, when I mention yesterday, I'm referring to the prior trading day. Anyways, bar one, we had a few things. We gapped down, and because of the higher time frames, it's consecutive sell climaxes on the daily chart or the 60-minute chart. And you know that there's probably buyers not far below. Trying to adjust the screen to make it a little easier to see. So first bar of the day, big. I say that first bar of the day, bear bar, but a tail closing on its low, near its low. Whenever you get a bar like bar one, you know that the market is probably not going all that lower. Bar one, as I say in the blogs, 20% chance that bar one is the low or the high of the day, and 80% chance that bar one will lead to a trading range. So at this point, there's probably an 80% chance that whatever sell-off we get will become a trading range. Bar two, bear bar closing on its low. Are we always in short? We're always in short from the gap, but this could be a final flag and we could reverse up pretty sharp. Bar three consecutive bear bars, but a tail below one, tail below two, tail below three increases the probability that this is a wedge on a smaller time frame. And then bar four, a little bit of a surprise. Obviously, traders buying near 4,200. Is bar four always in long? I suspect it probably is. Some traders will wait for consecutive trend bars. But at this point, the odds are this is an opening reversal, and we're probably going to test yesterday's 81. And then bar five, we have a follow-through bar closing on its high. Is it always in long? Probably. You can buy the close, betting that will go at least a little bit higher. It's not clearly a trend yet, but it's at least consecutive bull bars. And the first reversal down will probably fail. 6, 3 consecutive bull bars, 3 of them, all 3 closing near their highs, just below Friday's low. Probably going to break above it and try and go above the moving average. Because of how climactic it is on the daily chart, it's reasonable to assume that we'll have a pretty deep rally today, maybe test the midpoint of Friday's range. 7, doji, disappointed bulls who bought the close of 6 may look to get out break even, but probably buyers below 7 scaling in lower. Some traders, they sold the 1 high, they sold the 2 high, scaling in higher, and they'll try and get out break even on 8. 9 inside bar, probably buyers below 9 scaling in lower. But you can see buy the close bulls on 6, disappointed with 7, getting out break even. And excuse me, that was 8. 9 bull bar closing above the moving average. Probably going to go at least a little bit higher, but we may pull back first, may have to test the open of the day, and probably will have to test the bar 1 high right here. 10, we broke below 9 and reversed up. So an outside up bar. Outside bars typically lead to trading range bars, and because of the overlap on 10 and 9, we're probably going to start to go sideways fairly soon. But always in long, you can buy for any reason, betting that the first reversal down will probably fail. And then 11, 3 consecutive bull bars, bar closing, and it's closing pretty much completely above the moving average, so a sign of strength by the bulls. And then 12, you can see trader sold it with overlapping bars here, tight trading range here, and a trading range. We have a bear trend on the higher time frames, so you know this rally is probably going to evolve into a trading range. What about buying below 12? I would not. There's probably buyers somewhere below 12, but we could easily test the one high before the bulls come in. And then 13, a consecutive bull bars, but the tail on 13, and it's in the middle of the range from the low of 3 to the high of bar 12. Probably a second leg down, likely. But for the bulls, they'll see it as a high one buy, and they'll try and get a reversal up. And the bears will see any pullback as a lower high, and they want a second leg down. And then you can see on 14, bulls obviously bought the close of 13. There might be sellers above 14, but with it being a bull bar closing on its high, and with the odds favoring a second leg up after the rally to 12, I suspect that a lot of bears who sold below 12 might exit above 14. 15 consecutive bull bars, 14 and 15. So any bear that sold the 13 high or the 14 high is trapped, and they'll probably use any pullback. They're trapped, and they may look to get out on any minor reversal down around break even. 16, inside bar, probably buyers below, testing the 14 high. And then 17, you can see what happened. Bulls who bought the close at 15, disappointed 16. They used any rally to sell, and we're testing the 14 high, so we might find buyers here. You can call it a second entry sell or a lower high, major trend reversal, bull trend, trend line break, lower high. But whenever the trend line break and the retest is only a few bars, especially when the rally itself is lasting several bars, this is not enough of a trend line break, and it usually leads to a deeper, more complex pullback. And for bears betting on a reversal, it usually leads to a trading range. 18, you can see bulls bought the overlapping bar on 17. Also, whenever you have an overlapping bar like 17, it's really not a great signal bar. It's overlapping the past 3 bars, and that increases the odds that 17, 16, and 15 is more of a trading range, and 17 is not a reversal of anything. 18, reversal up, but the same problem as 17. 18, reversal up, same problem as 15 and 16 and 17, all overlapping bars. Probably will get at least a small second leg up after 14 and 15. And the bulls, they're trying to trap the bears who sold above 13 or 14. And ultimately, the bulls want some kind of measured move up, maybe a measured move from the open of 4 to the close of bar 6 right here. $19, doji. It's a weak follow through bar after 18, but it's a bad bear bar to sell. So probably buyers below 8, buyers below 19. 20, you can call it a failed breakout of the tight trading range or the 12 high. But who's going to sell below 20? Probably not many traders. And the bars are holding above the moving average. That will lower the probability of selling below these bars. And if I said who's going to buy below, I meant who's going to sell. 21, bull bar closing on its high. Bulls, they're breaking out of a trading range Because the market is in a trading range right here, the probability is much closer to 50-50 that the bulls will get an upside breakout. Whenever you're in a bear channel like this and you break to the downside, the odds are high you're going to get a reversal up. Whenever you're in a tight trading range and you break out to the upside, the probability is much closer to 50-50 that you get a reversal up. That's why here, tight trading range, you have to be careful about a downside breakout. Here, tight trading range, you get a bar like 57, you're probably going lower. 22, bull bar follow through after 21. Is it by the close? Probably, but it's the fifth or sixth consecutive bull bar since 18, and it's a micro channel since 18. So there's probably sellers not far above. But the reality is the first reversal down will probably fail, and that will at least lead to a trading range. 23, another bull bar, but a tail above 23. You can see the bodies are getting smaller. The overlap, there's not a lot of overlap, so that increases the probability that the market is going to go higher. For the bulls, they're hopeful it's the start of a small pullback trend and that we continue all the way up to this target and the high of the day. And then 24, hesitation bar. Whenever you get a buy the close rally and you start to get hesitation bars and overlapping bars like 24, the odds are it's going to start to pull back and go sideways. So a lot of traders, when they see a bar like 24, they'll look to sell some either the high of 24, close of 23, or a couple of points above 24. Sometimes, rather than selling the high of 24, traders will wait for another bull bar and sell it, betting that the market will retest somewhere around the 24 close. 25, bull bar closing on its high. Good for the bulls, probably going higher. But again, we have bull bar, dojis, bull bars, and a rally, and then a doji. So what do you think is going to happen on 25, 26, or 27? It's probably going to pull back and test the 24 close. 26, almost completely overlapping 25. So that increases the probability that the market is going to go mostly sideways. And then you can see 27, bulls selling out of longs, and we're testing near the 24 close. Is 27 a strong enough surprise that will sell off and test the 12 low? Well, I do think we will. I do think we'll get down to the 12 low at some point today or during the overnight session. But the channel up is too tight. The first reversal down will probably fail. You might have some traders selling below 27, but the risk reward is not that great. It's a big bear bar low in the channel, and that increases the probability that there's buyers somewhere below. 28, doji. So a lot of bears who sold below 27, disappointed 28, will look to get out break even, and that's what they did here. 29, inside bar, breakout mode bar, possible final flag if we break out to the upside. I suspect probably because it's a minor reversal in a tight bull channel, we're probably going to go at least a little bit higher. 30, bull bar closing near the high of 26, breaking out of the tight trading range or the triangle, which is 28 and 29. Because 30 is closing on its high, we'll probably go at least a little bit higher. But you know the bulls who bought the 26 close, disappointed by 27 and 28, they'll probably look to sell out of longs up here. So I suspect we'll probably go sideways fairly soon. 31, bear bar. So the bears who sold above 29 and more on 30 made money. You can call it a double top with 26 and 31, but not enough of a reversal, probably a minor reversal, not enough to be a major reversal. So if we break below the 26 low, I suspect probably buyers. We tested the high of, this breakout point, high of 1, low of 14. I think it tested it to the tick. Let me see, 35.75, 36.25. So it came within 2 ticks of the high of bar 1. And we have another breakout point on 12. So what do you think is going to happen at the high of 12? Well, if we tested this breakout point, the high of 1, and we came within 2 ticks on 14, the high of bar 12 is 52 and a half, and the low of this bar is 55.25. So that means the market is about 9 ticks above this high, which is the high of 12 and the low of 28. Trends get weaker over time. And what that means is we're probably going to test the high of 12 and at least come within 2 ticks of the high of 12, maybe 2 or 3 ticks. But this is probably not an adequate test of the 12 high, especially with it being a big bear bar. 32, second leg up after 30. So 30 is a little bit of a surprise. We pulled back on 31, and then we got a second leg up on 32, testing the high of 26. Good for the bears. They're hopeful that the bulls who sell somewhere, the bulls who bought here will be disappointed and sell out of longs. But because the channel is fairly contained and it's fairly tight, it increases the chances that we continue to drift up. 33, bear bar closing on its low. What about buying below 33? It's a second entry sell. It's a possible wedge. We rallied on 28, sold off on 29, rallied on 30, sold off 31, rallied 32, sold off 33, and it's a double top with 26. So you might have more bears selling below 33, taking a chance that we'll test the 28 low or the high of 12. 34, big bear bar closing on its low. What about selling the close? Some traders might, but you're selling near the low of a tight trading range, and it's a possible second leg trap, and that's what happened on 35. 34, if you sold the close at 34, you actually had, I think, about a minute. The market hesitated during this bar for about a minute before it reversed up. So even if you sold the close at 34, taking a chance we would plunge down to the low of 12, you had at least 60 seconds to get out, pretty much break even. So think about that for a minute. If you sold the close of a bar such as 34, and in the first couple of seconds of the open of 35, the market did not race down rather quickly, ask yourself, is your premise valid? Of course not. You're selling the close at 34, hoping that the market collapses. And if you sell the close at 34 and the market just goes sideways, that means the market's not collapsing. And that means your premise is not valid. 35, bull bar closing on its high, almost an outside bar. It's a big bar. You can call it a moving average gap bar. We've been away from the moving average for almost 20 bars and a two-legged pullback. For the bears, any bear that's sold below 33, I would get out above 35. We're still in a bull trend, still always in long and possible targets above. What are the targets? Well, one obvious target is the open of 4, close of 6. Another target is the low of 3 and the close of 12. We have a breakout point there, which is all the way up here. I don't think we'll get there, but let's see what other targets. The low of 3, high of 12, and then a pullback to here. That's probably more reasonable. But either way, we tested the gap, the 12 high during 28, and then we tested it again during 35 and reversed up. So it's possible this is an open gap. And there's several measured move targets just above the low of 14, high of 12, not far above. So we have two targets, the open of 4, close of 6, which is basically at 67.75. And then we have the low of 14 to the high of 12, which is right at 68.75. So all within a point difference. 36, bull bar. So bears did not immediately sell the close of 35, and bulls did not immediately buy. Consecutive bull bars, probably buyers below 36. For the bears, if they sold the close of 34, they're trapped with 35. And some of those bears are trying to get out around their original entry. They sell the close of 34. They sell more above 34 or above 35. And they're trying to get out break even. And you can see what happened on 36 and 37. The market is not letting those bears who did sell the close get out at the low at break even on their entire trade, close at 34 and scaling in up here, or at the close of 34. So there might be more buyers below 36 and 37, and that will increase the probability that bears might give up here. 38 bull bar breaking out above several highs, tight trading range in here. And remember, 50-50 chance you get a bull breakout, 50-50 chance you get a bear breakout. So if the probability is close to 50-50, you have to respect the possibility that this will be a successful breakout. Very close to these measured move targets. And then 39 is a bear bar closing on its low. What about selling below 39? Some traders might, but the channel up is fairly tight and bears are not making that much money. So if bears are not making money, you might have less traders selling below 39 than buying. Because the channel up's fairly tight, you will have traders who will wait to sell below the moving average if the bears can get sustained selling. So like right here, bar 13, good for the bears. But the bears realistically probably needed one more big bear bar, which would be 2 consecutive bear bars below the moving average. I do think with 12 and 13, we should have gotten a small second leg down, and arguably the leg down was right here. So this is a trap. It trapped bears who sold the high of 13. And you can see 40, the bulls prevented the bears from triggering the 39 low. So some bulls, they moved their stop. They're long, they moved their stop one tick below 39, and they start buying aggressively, trying to prevent the bears from triggering the sell below 39 and driving the market higher. 40, high one buy. You can also call it a wedge, 36, 38, and 40, or with here. So it's a nested wedge, 1, 2, 3 for the first push, 1, 2, 3 for the second, and maybe a third push here. Either way, or you can say it's 1, 2, and 3. But because of that, because we have 3 pushes up, you have to respect the possibility that we get some sort of upside breakout. So here's possible. It's not a great wedge shape, but it is a wedge. 1, 2, 3. With 41 closing on its high, that will reduce the amount of traders selling the close of 41. And we have, because of the targets above, high of Friday, leg 1, leg 2, which is this great line, leg 1, pullback, leg 2. We can easily vacuum all the way up there. And you can see what happened on 42. 42, big bull bar. A lot of traders who so a lot of traders who bought for any reason, they will see 42 as a gift, and they'll take profits on 42. If you bought the close of any bar, let's say you bought the close of 41, your entry price is 67.5, and now the market is all the way at 80.25. So you've almost made 13 points in one bar. So a lot of traders, Al always calls this strong bulls exiting on their longs, final bulls exiting on their longs, and weak bulls buying the close, let me back up. Strong bulls, as Al says, will take profits here. Weak bulls will buy here. They're buying because they could not get long through here, and they're worried the market's going to just race up. Strong bears are not selling here. They started selling below 12 all the way up, and they're not going to be shaken out. That means you really only have you have weak bears and weak bulls. The weak bulls who were buying, they were buying all the way up. And the weak bears who were selling in here, they're panicked. They panic on 42, saying they can't take the pain anymore. And they end up exiting the trade, only for this to happen. 43, bear bar, closing below its midpoint. Strong enough reversal, probably at least a second leg down likely. That means always in bulls, I would get out below 43. And no reason to buy above 44. Bad high one, so probably sellers above. 45, bear bar closing on its midpoint, but 3 consecutive non-bull trend bars and targets below the 42 low and probably the 40 low. The bottom of this rally, and maybe it's all the way down here. Either way, There's probably sellers above 45 for at least a little bit lower. 46, bear bar closing on its low. Possible wedge with 43, 45 in this bar. But I suspect the sell-off is strong enough that any reversal up will be minor. And there's probably sellers above 46 if we get there. We may have to get all the way down to the 35 low. You can also call it a failed breakout of a channel. Someone just made that comment. So there's the channel. That's what they're referring to. Spike, pullback, channel, and we're trying to break out above it. And if you do a best fit line, you would see we did break above it. You could draw the channel right here. There's the bottom of the channel. Make a parallel. And you can see we tested it almost exact. So no surprise there. I'll just leave this drawn for now. Whenever you test the top of a channel, you expect, at a minimum, test the bottom of the channel. Doji on 47, probably buyers below and sellers above for at least a little bit lower. But a trading range is more likely than a bear trend. 48, failed breakout below 47, and the momentum is weakening. Probably going to pull back for at least a couple of bars, but I suspect if we do rally, we'll probably form a lower high and get a second leg down. 49, bull bar breaking out above 48, but probably sellers not far above, although we might rally for a couple of legs. And then 50 consecutive bull bars, probably buyers below 50, scaling in lower for at least a small second leg up. But I do expect leg one, pullback, leg two. 51, another bull bar. We rallied on 50, pulled back on 50. We rallied on 49, pulled back. On the close of 49, we rallied on 50, pulled back on that bar, and then we rallied again on 51. Because of that, it's a wedge on a smaller time frame, and you know there will be traders selling above the high of the first big bear bar right here. 52, another bull bar. What about buying the close of 52, betting on a reversal and a breakout above 42? Some traders might, but you have a lot of overlapping bars here. And because of that, this looks like a leg in a trading range. And then you can see 54, 53, closing on its low. Bears sold the high of 45, more higher, getting out. And for the bulls, I think a lot of traders who bought anywhere in here will get out below this bar. 54, decent entry bar for the bears who sold below 53, and it's a test of the 48 low. So you had bears selling all the way down to the 48 low. They scaled on higher, and they're getting out break even on 54. 54, is it a decent buy the close bar? Some traders might buy the close betting on a pullback, but you do have trapped bulls. You had bulls who bought during 51 or 52, and they got trapped on the pullback 53 and 54. So it's a bear breakout of a channel. This rally, these consecutive bull bars are a channel, and we broke below it. And then you can see 55 sold off on 54, rallied, sold off on 55, rallied, probably sellers above and sideways. 56 bull bar testing near the low of 52, 53 low, probably sellers not far that are close to it. And you can see 57 we sold off. So what happened on 56? You had bulls who bought below any of these bars, 51 low, 52 low, even the 53 low, and they scaled in lower. They were so disappointed by the sell-off on 54 and 55 that they used the bounce on 56 to sell out of longs, and that's what caused 57 to reverse down. 58, a decent entry bar. So 57, 58, breaking out below several bars to the right. Possible wedge, 48, 55, and 58. Testing near the bottom of a channel, the 35 low. But we also have the target of this gap as well. So I suspect we'll probably go at least a little bit lower. But the tail on 57 and 58 is a problem for the bears. And that's what led to 59 being a doji. 59, doji, possible 2 legs down in a trading range, but bad buy signal bar above. And that will increase the probability that the market goes more sideways. 60, doji bar, probably sellers above 59, probably buyers below 60. And then 61, bear bar closing on its low. Some bulls who bought the low of 60 will get out below 61 because it's closing on its low and there's targets above. I do suspect we will fall below the 59 low, but I suspect we'll probably not break far below the 59 low. And instead, we reversed up sharply. What about buying the close of 62? Bull bar closing on its high. Some traders might. It's overlapping a lot of bars, and it's a small higher low from 59. So it's a possible second leg trap. Rally, pullback, second leg. And it's testing breakout prices where traders got trapped. 63, sharp reversal down. And if you remember, if you saw this on a 1 minute chart, you would actually see that 63 was a really big bear bar. So you had this strong rally right here, and this is during 63. In the final minute of the bar, we had this really big bear bar. So this sharp reversal. And whenever that happens, whenever you get a sharp sell-off, usually it will limit the upside. I just can't see it that well. So here's the rally right here. And then here in the final minute is this big bear bar, and that's bar 63. So when you look at 63 and you see how fast it sold off like that, you know you're going to get a brief second leg down. So you had traders trapped. Bulls bought up here, which is basically the highs up here, and they scaled in as the bar reversed down quickly. They bought more lower. What are those traders going to do? They're looking to get out break even. And you can see what happened at the breakout point right here. The market rallied on the next bar here and then sold off for a second leg down. Now, what do you do if you buy 62 and then you see 63? A lot of traders, if that happens, they'll just look to get out. If they bought the 62 close and they're disappointed on 63, they'll look to get out break even or near maybe the upper third of this trading range bar. 63 is not a great bar to sell because it's overlapping a lot of bars to the left. It's the same issue as 62. 62 is not a great bull bar because it's overlapping a lot of bars to the left. And then 65, bear, it's a doji, so not really all that great of a buy. 66, overlapping bar, so trading range. And then 67, breaking out to the upside, but overlapping bars near the high of 63, where bulls got trapped. Not really a good buy the close bar. And then 68, a little bit of a surprise. You can argue it's a failed breakout above 63. So the market rallied, sold off. We tried to test it on 67, sold off on 68. Some traders might sell the close of 68, taking a chance that this is a bear flag and we race down. And you can see 69. 69 sold off and rallied quickly into the close of the bar. What about buying the close of 69? Some traders might, but I suspect it's a bad buy signal bar. And because of that, it might be a pullback leading to lower prices. As far as selling, I would not. It's 3 legs down. 1, 2, 3. And it's probably a failed breakout of a bear channel. So there's the bear channel, 1, 2, 3. And because of that, we could easily test up here. And instead, 70 is an inside bar. Inside bar, it's a retest of the low of 69. Probably buyers below 70 for a brief second leg up, but channel down's tight, 4-bar micro channel, bear bar on 70, closing below its midpoint. It's a bad stop entry buy above 70. So a lot of traders will wait and see if we get a bull bar. And instead, we broke to the downside, testing the low of yesterday. 72, follow through after 71. But we're so late in the day, and what do you expect is going to happen? The reality is there's probably buyers near the bottom of the channel. We had a spike, sell-off. The sell-off was the start of the channel. You know there's probably buyers not far below. 74, bull doji. It's a doji bar. It's a bad stop entry buy, so probably going to go more sideways here. I do think the bulls that bought the 69 low and more lower will make money. 73, even though it is in a sell to close market, some traders, they'll look at 73 as a warning that the sell to close sell-off is not going to last much longer. So a lot of traders, when they see 73, they'll be quick to get out on 74 or 75 if they're short. 75 tested near the 73 close, no surprise. Probably sellers above 75 with the tight bear channel. And then 76, bull bar closing on its high. What about buying the close of 76? I would not. It's the first breakout above a fairly tight channel that will probably get at least a brief second leg down. And that's what happened on 77. 78, doji, probably buyers not far below, but too late in the day to really do anything. For always in, I thought it was okay to. Some traders might sell the close of 2. I think it's pretty tough. I think high probability reversal. So I think that's a tough call. And then probably always in long 4 or 5. I think they get out below 12. And do they buy again above 14? Some might, but 14, because of 12 and 13, the bears may get at least a brief second leg down. And because of that, I think some traders might be resistant to buying above 14. But if they don't buy there, the bulls probably buy again above 18. And bears, I get out above 18. Too much risk of an upside breakout. Always in long through here. Do they get out below 27? Some bulls might, but not really a great place to sell. If they don't get out below 27, they might get out below 33. And you might have some bears selling below 33. But 33, again, not a great. It's a minor reversal at best. So if you're selling below 33, you're hoping that 34 and 35 are very big bars breaking far below the moving average. And that's not what we got here. Always in, bulls probably buy again above 35 and bears exit above 35 if they're still short. And then I think the bulls certainly exit during 42 or on the close of 42 or below 43. And bears, they'll go short below 43. What about buying 49, 50, or 51? I would not. It's probably a minor reversal, and the bears will probably get a second leg down, which they got. That also means bears can sell below 53. And then not really any good buys in here. You can buy above 62, but forcing you to buy high in a tight channel. And forcing you to buy just under the moving average, not really ideal. And then really through here, it's a trading range. So 50-50 chance, it's triangle, 50-50 chance to get a bear breakout, 50-50 chance to get a bull breakout. Here, the bears tried 2 or 3 times, rallied on 60, sold off, rallied, sold off, rallied. So I think it's okay for bulls to get out below 68 if they're still long. Aggressive bears might sell. And if they did sell, there's really no reason to get out. Some bears might get out a couple of points above 69 or 70, but you can see it never triggered. And then I think a lot of traders, they might get out above 75. I think that's okay. Or they use a wide stop. The only problem I have with the wide stop here is if you're using a wide stop and you're getting a trading range, sell off, pull back, sell off, pull back, sell off. It's 3 pushes down, 1, 2, 3. And what do you think this tail is right here? That's the start of a channel. And if it's the start of a channel, we could test very close to it. So remember what Al says about spike and channels? Let me just make sure I'm looking at the right time here. So this is 13:29 to 30. So that's right here. So sell off, deep pullback. You know that this deep pullback is the start of a channel. And what that also means is the rest of this is a leg in a trading range. So leg 1, pullback, 2, and 3. So that's 3 pushes down. That's a bear channel. Channels often reverse and test at least the 50% of the channel. So if the top of the channel here is here, the bottom channel of the channel is here, it's reasonable to expect that we test really close to the high of this bar. And because of that, it's really close. Because of that, we could easily go all the way up here. Someone asked me to review BTC. Are you asking for Bitcoin? If you are, just reply yes. And that's in part why we sold off. We tested near and then we sold off. But I think it's okay to exit longs above here and just wait. Limit orders, probably buyers below 9, but and then what about buying below 11 or 12? I would not. The market, some traders might, but we could easily get a deep pullback all the way to the breakout point. And then probably buyers below 17, betting on a second leg up after 14 and 15. And then here, not that easy. It's another micro channel. Probably buyers. Let's see, where are there buyers? There's buyers at the moving average and buyers below bars like 28, but there's not buyers below bars. I think it's pretty tough to buy below 33. And other than that, I think there's sellers above. For one, I think there were sellers above this bar or on the close of this bar, bad high 1, probably sellers above 46 or sellers just above these bars scaling in. I thought buyers somewhere down here, 3 consecutive bear bars. So it's basically breaking out of a bull flag. So bull flag, pull back, betting on a second leg up, probably buyers below. And because of that, 54 and 55, it was a strong enough sell-off. There's probably sellers above. And because of that, I thought it was reasonable. Maybe not sell the 55 high, but sell near the breakout point of this bar right here, 53. Probably buyers below 60, low 1 short after several legs down. So probably buyers below. And that's probably it, really. You could sell above bars if you're willing. And then here, a micro channel from 67 all the way to 75. That's a pretty extended micro channel. And that will reduce the probability of traders selling. 1, 2, 3, 4, 5, 6, 7, 8, 9 bar micro channel makes it really hard to sell above the 9th bar. A lot of traders, they want to sell after 3 or 4 bars, not necessarily 9 bars, because the more bars added in the micro channel, the greater the risk of exhaustion. By the way, this spike on 71, pullback 72, and channel down 1, 2, 3, or 1, 2, and 3. That's the equivalent of this spike, pullback, and then a channel. The pullback's the start of the channel. And because of that, it's reasonable to expect that the market has to retest the start of the channel. That happens all the time. Buy the close, sell the close. I thought it was reasonable to buy the close of 4, 5, or 6. And you could even buy the close of 9, 10, or even 11. But if you're buying the close of 9, 10, or 11, you know that there's prior selling pressure here, selling pressure here, and it's possible parabolic wedge. 1, 2, 3. And you could get a fairly deep pullback, but the rally is strong enough. We'll probably get a higher low in a second leg. Maybe buy the close on 21, 22. What about buying the close 15? I would not. It's a retest of the highs after 12 and 11. And you know it's a retest of the highs after 12 and 13. And you know that 12 and 13 is a strong enough breakout. We'll probably get at least a second leg down. And in this case, traders got trapped. If I am buying the close of 15, I think you need a wide stop. So buy the close through here. And then I thought if anything, 42 is a sell the close bar, not a buy the close bar. And the safer thing to do is to wait for the bear bar and either sell the close or below 43 or 44. And then what about 52 or 51, 52? I thought that was more of a sell the close bar. It's a test of the breakout point right here. So we'll probably get a second leg down and then probably sell the close on 71, 72. But you're so close to the channel that you got to be really quick to make decisions down here. Okay, let me take a look at questions. Question about stops, and they say they're not at the videos yet. If you buy above 49 for swing, is your stop below 48 or 35? For one, I would really suggest you got to finish the video course, but What I would really suggest most traders do is break the course up into pieces. So, for one, if you're buying here, it's not really a good area to buy. It's the problem with buying here is if I bought above 49, I'm putting my stop below 49 or 48 because it's a low probability trade. The odds are you're going to get a lower high and a second leg down. You had bulls buying all the way up here, and a lot of those traders took profits here. And if they're taking profits on 42, which that's what led to the sell off on 46, 47, those traders are not going to look to buy again within a few bars. The other thing I would say about this is there's 130 hours, give or take, of the video course. And if you take any pattern, let's take a wedge. How many wedges, how many variations of a wedge can you really get? You can really get a lot of different examples. And that's one of the reasons why traders have a lot of trouble trading. They watch the video course, they understand the video course, but the market is kind of like melted plastic, as Al says. The patterns are all the same, but if you melt plastic, it's never going to look the exact same way every time. What I think a lot of traders should focus on is try and get good at doing a few things really well and then graduate to doing more things well. So if you're going to trade, if you have time to trade the open, what would I do? I would first watch the video course. If you're trading and you haven't watched the video course, for one, that should be your first goal. Watch the video course. But number two, if you have watched the video course and you've had some experience studying the material, I would focus on something like trading the open. And there's a video we did in, I think it was July the 6th, that discussed the encyclopedia. And one of the topics I discussed was trading the open. So you can watch that video. It's on the Brooks trading course. But anyways, back to why would I recommend trading the open? Because it's some of the things I talked about with the blog. Most days lead to a swing. Most days present a swing. And think about all the things that the open can do. You can get an opening reversal, you can get a trend from the open, you can get a trading range open. So if I can get really good at diagnosing the open of the day, maybe I can find one or two trades a day. Then, if I can improve on that, maybe I can start adding other pieces to my trading. A lot of people screw up with trading because they're kind of all over the place. And when you think about someone like Al has traded for so long, he's virtually seen everything numerous times. So nothing surprises him. His brain has naturally become accustomed to being very fast to react almost to a subconscious level. He automatically knows what a good signal bar is, what a bad signal bar is. You listen to him in the room, you hear him all the time say, such and such, if such and such would have closed one tick higher, I would buy above this bar. But because it's got a one tick tail, I'm not going to buy it. That's his experience. And a lot of people, they think that they can take the video course and learn from that experience. You can, but you're going to get there a lot faster for one, just to be very, very clear, you have to study the video course relentlessly and daily, numerous times. And I'm not pointing this individual out. This is more of a topic I just really want to discuss. You have to watch the video course numerous times, but also think through getting good at a few things. What I would recommend getting really good at is understanding what the difference between a major and a minor reversal is. What's a major reversal? What's a minor reversal? If you can understand what a major and a minor reversal is, you're going to set yourself up for a lot more success down the road. Why is that? Well, you have a strong rally and a trend line break. It's probably a minor reversal. So if I just avoid entering on the minor reversals, I'm not going to sell down here. I'm also not going to sell here because I know it's probably minor and it's probably going to lead to a trading range here. Tight bull channel. Guess what? That's too tight. I need a new minor reversal. Leg one and then a retest. Is that a good short on 33? Not really, because it's minor. You're probably going to get a deeper pullback. 36. Okay. Now we've broken the trend line by a couple of legs. Right here. Two-legged pullback. So if you buy above here, what are you expecting? Well, we've made a tight trading range for a lot of bars. Maybe this is a final flag. Anyways, the point with that is your goal when you're learning how to trade and you're trying to figure all this out, your goal should be, how do I break up what I'm doing into small, simple pieces? You don't need to be quote unquote Al on day one or year one. And most people in 10, 15 years will not become Al. And the truth is nobody will be Al, because Al is Al. He's his own person. But if you want to give yourself the greatest chance of getting very good at trading, or progressing in trading faster and faster, take the video course and put it into small pieces. So everybody wants to scalp and scale in, and that's fun, but that's not what most traders should do. What you should do is get really good at swing trading, become a master at swing trading, become a master at diagnosing what a minor and major reversal is. If you're going to do that, that means you have to become a master at understanding what the market cycle is. Get really good at identifying line charts. So throw all this away for now. Take a line chart. Can I understand what's going on here? Yeah, we had this really big rally, very deep, 2 or 3 pushes down, started to go sideways, rally, pullback, buy climax, testing this breakout point, but strong sell off, deep pullback, probably a second leg down, trading range here. We broke below the range. Practice being able to read context. But, anyways, the first thing I would tell everybody is get good at understanding swing trading, which is basically saying understand minor and major reversals. But back to your question, if you're buying here, it's a minor reversal. This is a strong enough sell off. You're probably going to get a second leg down. So if you're buying here, where do you get out? I get out below this bar. If the trade's going to work, I don't want a big bear bar. Whenever the market's in a trading range and I get a big bear bar against me, especially after my trade has gone on for a couple of bars and it's near resistance somewhere up here, I generally want to get out of the trade. Here, I definitely want to get out of the trade because there's too much risk that we're going to test lower prices. Were we always in short on the close of 46? Yeah, I thought we were, but it's a trading range. Remember, whenever you have a bull trend and you get a strong trend line break, most of the time the market evolves into a trading range. So if you're selling down here, you really need to be prepared to scale in. I think this is more of a profit taking area. There's bulls. Bulls will buy below these lows, betting on a trading range, and bears, they'll buy back shorts down here. Those bears were selling the close of this bar, below this bar, below this bar, betting on a test of the moving average. And a lot of those traders, they'll take their profits here and they'll look they'll look for a lower high. Why a lower high? Because if the market forms a lower high and breaks below 48, it's confirming to the bears that the market's now in a bear trend. You're getting a low, lower high, and then a lower low. Is it a good short below 63, quote unquote low 2 at the moving average? 63 is my only problem with selling below 63. It's a really big bar and it's overlapping almost the entire prior bar. And whenever you get a big bar that's overlapping the prior bar, that's usually a warning that something is wrong. More often than not, it's a trading range bar more than a strong bear bar. Plus, ask yourself, what's it reversing? We had a tight trading range, 59, 60, 61. We broke above it on 62, 63 and reversed down. So to me, it's not reversing much of anything. This bar, it's reversing 42. This bar broke to the upside, somewhat reversing, but it's still part of a tight trading range. So the negative piece is the bar is fairly big. Is it okay to sell below bar 2 and get out 2 points above any bar? Can you sell below bar 2 and get out 2 points above any bar? You can. My only problem with the logic here is, again, what I said. I say it every day in the blogs. There's an 80% chance that you're going to get a trading range open, there's an 80% chance you're going to get a trading range open, and a 20% chance you'll get a bear trend from the open. What that means is 80% chance if you get a sell off, you're going to get some kind of opening reversal. I'm looking for ways to trade more at the open. That's good. And what I would challenge you to do is figure out, how do you trade a trend? There's three opens: trend from the open, opening reversal, trading range. So diagnose it into two types of opens. There's a trend from the open, and then there's a trading range open. So start with the trend from the open. There's a 20% probability most of the time. What are the characteristics of strong trend from the opens? Well, it doesn't take a lot of research or quote unquote homework to go back. Right, trading range, is that a trend from the open? I don't know, maybe. But the characteristic, one of them is you start to get strong bull bars. But even here, tight trading range for a lot of bars. So that's more of a breakout mode on the open. Here, let's see. Big bear bars, but a lot of overlapping bars and a reversal. Here, tight trading range for a few bars and then lots of bull bars. But one way you can trade it, buy the close and just get out a couple of points below any bar. It also helps if you understand the higher time frame. That was one thing I thought the Bears had. One thing that was against the Bears right here. Do trading ranges on daily charts behave similar to as similar? Let me start over. Do trading ranges on daily charts behave similar to lower time frame charts like 5 and 15? Yes. The moves are bigger, but I say that it's actually the exact same. In percentages, the moves are bigger, but because it's a higher time frame, but overall, it's the exact same guy. Why do you think we will get to the 12 low today? It's probably a breakout point. Yeah, right here. The one high and the 13 or 14 low. We tested this breakout point to the tick almost, came within 2 ticks. Here's the breakout point. Here's the breakout point, 12 high. We broke above it during these bars. If this breakout point probably pretty much closed, came within 2 ticks. This is too big of a gap to be open. Channels evolve into trading ranges, which means trends get weaker. A channel is the weaker part of a trend. And because of that, the odds favor the pullbacks getting more complex. Question: what do you think about the Emini end of day setups that Al makes for the blog every day? I really don't like them very much because it's full of buys above bars and sells below bars, but during the day, there aren't many good stop order setups. I think that Al marks these setups without paying too much attention. Well, that is a very interesting question you raise. Number one, from the inception of those charts, it's always pointing out stop entries. I used to have this exact same thought. Why does Al mark up all these charts? He gives so many stop orders. And what I remember thinking was, Al, I didn't say this to Al, but it was my thought out loud. My thought was, Al, there's 3 or 4 of these stop entries that just looked horrible and they didn't work. However, the more I thought about it, I thought longer and longer and longer about it. And eventually, there's one thing that dawned on me that I couldn't get out of my head. Every one of these stop orders that Al marked, and by saying these stop orders, what I mean is there's a lot of stop orders on a chart. And what I started noticing was the stop orders that Al would mark, even a bar like selling below 12. Sure, it failed eventually, but it did not fail. It took at least 2 or 3 bars to actually fail. So then I realized something. Getting a scalper, the trick with selling, with having a high probability winning percentage trading with stop entries, is being very quick to respond. If you sell below 12, guess what? 13 goes your way, but then it hesitates. You get a tail on 13, and then 14 starts to reverse up. What are you going to do? Well, if you understand what's going on here, it's a test of this breakout point, you'll exit and you'll lock in a couple of points profit. If you sell below this bar and then you see 28, 28's terrible and is a terrible entry bar if you're selling below 27. What can you do? You can get out break even on this bar. Sell below this bar, 33. I took that sell, taking a chance we would test down. I knew it was minor, but I was taking a chance we would test the breakout point. And then 34 closes a bear bar. I remember I waited, I think it was 30 seconds or maybe 20 seconds. This bar sold off and then it hesitated for about 15, 16. I don't remember how many seconds, but it hesitated long enough that I just said, screw it, this isn't going down. And I exited the trade. And then about a minute later, this bar reversed up. So why am I bringing this up? The point I'm making is I would really think more about your question. You don't like them very much. That's okay. You're saying that there aren't many good stop order setups. Well, saying that there aren't many stop order setups is an opinion. I can tell you that you should never scale in to any trade. It's a terrible idea. But the reality is, traders and institutions scale in every minute of every day when the market's open. So obviously, my opinion is an opinion. It's not a valid statement. So why am I telling you that? I'm challenging you to rethink what you're saying. Instead of saying that you don't like these setups and you don't like the charts and there aren't many good setups on the chart and that Al marks these setups without paying too much attention, I would first pause and ask myself, okay, one, and I would always do this. I would always try and do this. One, I always assumed Al knows more than me. And why am I saying that? Because if I'm going to, and I still believe this, obviously. And what I'm telling you is my mentality for when I was really heavy in studying in the video course. And I still study the video course. I still study Al's material. And the point with that is if there's something that I don't understand that Al's doing, maybe there's something I don't understand about it. So if Al is marking up a bunch of stop entries and saying these are good trades, pause for a minute and ask yourself, why is he marking up these trades? Maybe there's a logical reason and there's something that I'm not understanding. And by thinking that way, you will grow with experience. But I would invite you to, for the chart you're talking about, really think about, could these bars work? So on every one of the bars that he marks on those charts, ask yourself, would the trade have allowed me to get out break even? And a lot of times the answer will be yes. What about buying above 12? Oh, buying over bar 12. I think that's reasonable. And a lot of traders will do that. So a lot of traders, they see a trading range here and then they see the breakout and then the pullback. So some traders will buy above it, betting that if they're quick, they'll be able to get out. Other traders, they might wait for a close above the bar and then buy. But trading range makes sense to do that. And by the way, I'm not trying to criticize this person for the question, but and that was more of a question, that was more of a statement for everybody. Whenever you have an opinion, really think and test out your opinion and test the opposite of your opinion to make sure it's valid. Brad, could you have thought of the day as a trending trading range day composed of two large ranges, with the opening range being the gap high and the bar 3 low? Yeah, so you could say that reached a measured move based on the height on bar 42 of this height. Yeah, you could say that. So the market sold off, I'm sure, to here, and then it rallied somewhere up there. That's valid. And the way I'd look at it, some traders will see this as a sell-off, rally, and a rally higher, and then an overall trading range. As far as calling it a trending trading range day, I like to think about it as just more of a strong rally, pullback, and then a channel. 3 pushes up, 1, 2, 3. And the reason for that is, to me, this is the surprise of the day. The breakout 4, 5, and 6, and it's a strong enough surprise. The first reversal down is probably going to fail. So there's probably buyers somewhere below. And because of that, you expect 2 or 3 legs up. And when I say 2 or 3 legs up, I mean you expect at least 2 additional legs, and that creates the channel. If you can pinpoint where the channel is, you know you're probably going to test the bottom of the channel if the channel is not very tight or strong. So where do we go tomorrow? Well, I want to answer. There's one question I actually want to discuss about scaling in. Question: is it really not suitable for novice traders to scale in? In no way should they? Question mark. I think it's a bit of an exaggeration to say they shouldn't do it at all. Yeah, well, it is an exaggeration. The problem with scaling in for most traders is most traders will scale in the wrong way. So what's a reasonable way to scale in? Okay. Some traders, you buy the close of bar 4 and then you get follow through on 5. So you add on and then you get follow through on bar 6 and you add on. You're scaling into a winning trade. And a lot of traders that they buy here, maybe they have a target based on the range of this bar. They add on the close of 5 and they move their target from the open of 4 to the close of 5 and then they buy more on 6 and they move their target from the open of 4 close of 6 all the way up here. That's reasonable. What traders inevitably do when they start scaling in, they realize that if they buy the close of 42 and more below 42, they can break even on the entire trade. So all of a sudden they start to realize, hey, if I just scale into a losing trade, I'll never lose. And the truth is, they will not lose on most of the trades. But then this happens. This is the danger. They buy below 48. They buy more during somewhere down here. And let's say their break even price almost gets filled, or maybe it does. Maybe it gets filled right there. So then let's say they buy the low of this bar 38. They buy the low of 38, they scale in lower, they get out break even. But let's say for whatever reason, instead of buying the low of 38, they bought the low of this bar right here. And then they see these bars and they scale in lower. Their break even price never got hit. And then look what happened. The market's all the way down here. Well, what if the trader held overnight? If you would not have exited the trade at some point, you would have subjected yourself to a ton of pain. And let's make it even worse than that. What if a trader, it's not really a great example, but the point is when you're scaling in, a lot of traders can easily start revenge trading, buying the low of this bar, buying more, and really rack up a big loss. And everybody's done it to some degree, some worse than others. But the reality is I'd be really, really careful with scaling in, and I would have a max loss. I would just really be careful. The other problem traders have with scaling in is probabilities. In general, if you always want your reward to equal your risk, and it's really easy when you're scaling in to start scaling in, and next thing you know, you're taking trades where you're risking $100 to make $20, and that's a really dangerous thing. If you're buying, let's use this example. If you trying to think I'm not finding what I'm looking for, but let's say you buy here, you buy more, you buy more, you buy more, and you make this small profit right here. Your risk exposure was huge, and your profit was only a couple of points. That is why I'd be really, really careful. All right, so that is all for today. For tomorrow, what do we expect? Well, we have a strong enough bull bar. There might be buyers below for a brief second leg, but today's bar is disappointing, and there's probably sellers somewhere above the bar. And I think we're going to form a trading range. What I think is, I think the bears will get a second leg down, but everybody's paying attention to, okay, how eager are the bears going to be? Everybody knows this is a possible wedge. It doesn't look like a wedge, but it is a possible wedge. It's not the world's greatest shape, 1, 2, 3, but it is a wedge. We have this price level right here. So there's support down here. We could easily fall to 200 and then reverse up sharply. But right now, I think the bears want a second leg down and the bulls want a strong rally. All right. Hope everyone has a good rest of their day.